It's an exciting time in our industry. This time last year, we were wondering if we were going to have an administration that was going to shut the whole damn thing down, right? And that did not happen. So not only that, I think we got much more than we had actually even bargained for. We really hoped, with this election, to get like a little bit of support. Like, let's just have regulators that have even hands for everybody, gives the same rules to the crypto industry as not. As a story I tell from time to time, we had the Brian Brooks OCC from 2020. Now, Brian Brooks was the comptroller of the currency under the previous Trump administration at the tail end. He opened up the OCC, which is National Chartered Banks, to be able to support crypto. And that happened all within the last 6 to 9 months of the first Trump administration. The new administration comes in. Not a single line of legislation was changed. Not a single line of regulation was changed. And yet the interpretation of the exact same rules was completely night and day backwards from what the previous administration had. All of a sudden, crypto is off instead of being on. How does anyone run a business if without changing a single law, a single rule, and all of a sudden what you could do under one administration you can't do on the other? You just can't run a business that way. So, look, we were just hoping to get level-handed regulators. We got way more than that. We got a House, we got a Senate. They're all controlled by a party that's trying to push crypto forward. And there's one last thing which I think we really got, which is the most amazing thing. And I hate to be political. I mean, it's hard not to be political when they're attacking your business. But without being political about President Trump and whether he's good on all these other things, but just about crypto, we have a president who's trying to figure out how to make Bitcoin make America better, how to make crypto make America better. So if you're talking about the Bitcoin reserve as part of the U.S. Treasury reserves, he's thinking about that. Now, you can decide whether you think it's a good or not bad idea, but I'll tell you, the previous administration wasn't even thinking about it, right? David Bailey, who hosts this conference, as you might know, has had a big hand in kind of turning that around. I remember Trump came to the Nashville version of this conference just summer last year, right?
That's right.
Right. Okay. So,
and for the record, I think you were on stage in San Francisco before the elections, and we were talking about some of the same topics, and you were one of the few people that actually stated this belief and got some boos from the audience back then.
Really? Which
you
one?
did.
What did I say?
One of the San Francisco conferences
Okay.
about this would-be future.
Oh yeah. Look, it's tough in California. We're a little bit blue over there. But look, we got a president that's also thinking about like stablecoins, and so look, it does look like we're going to get stablecoin legislation, which will lead to regulation this year. Assuming that happens, that's good. And this president is thinking, can we use stablecoins as a way to make the dollar stronger globally? I'll tell you, stablecoins. You guys have stablecoins? You use stablecoins or all Bitcoin here? Stablecoins, all right, great. Look, stablecoins are the banks you wish you had but you never had. They are better in every regard. I'm gonna go out on a limb to a little bit of the future here because we can't quite do this. The legislation isn't quite ready. But stablecoins are 100% reserve. Banks are not. Stablecoins are going to give you like risk-free rate of interest. Banks do not. They give you 0.1% interest. And stablecoins are usable 24 hours a day, 7 days a week, all over the planet, almost for free. Banks are not. So it's just like there's a reason why the banking lobby has suddenly woken up and said, we're worried about this legislation. And they came in and they said, we need a few things added for us, please. And they asked for two things, which are both bad. One is they said, can we use bank reserves as the backing store to a stablecoin, which would make it not backed. That was kind of the whole point. And then the second thing they've asked for is that we not have an interest-bearing one. Imagine a stablecoin where you just every month you get an airdrop, 4% coming right in. That should happen. It's your money. Of course it should happen. We are a fiduciary trust company, which is a non-depository bank. And we have a fiduciary duty to deliver money to our clients. Like, really? We're going to pass a law which is going to say, yeah, your fiduciary duty is to not give people the money that they deserve from a risk-free rate. All right. Anyway, it's an exciting
That
time.
was a crash course on recent regs from our dear friend Mike.
All right.
Why don't we go back in time and talk a little bit about the past, BitGo's past, how it all started?
All right, let's go back in time. All right, so we've been doing this a dozen years now. So it's 2025. We started in 2013. This particular conference, I mean, I met David Bailey. I've met both of his parents. He was a younger kid then. He was a guy that was excited about Bitcoin. He was writing a magazine, et cetera. And we were all just trying to figure out how, what is money? And like, can this crazy thing called Bitcoin actually take off? We had conversations about what's going to happen when nation states start adopting this coin. How is that going to affect it? What's going to happen if we have an ETF? Is that going to be good or bad? What about self-custody? All these questions have been talked about for years, and now they're actually happening. So we started out, as you might be aware, really just as a technology company. We wanted to secure the asset so that people would stop losing it. Even back in 2013, people were losing their passwords, people were losing their hard disks, things happened, and you lose your coin. So then you try to put it on a website, and then the website rug pulls you. We didn't call it rug pulling then, by the way. I guess it was just called getting ripped off. But things have changed and evolved. 2013, a big wallet was like $10 million worth of Bitcoin. So we were using the multi-sig to do that. About 2015, things were growing. We are now taking on exchange assets coming into BitGo technology. Now we start to see $100 million wallets. By 2017, we started to see the billion-dollar wallets. This is where you have to start breaking it up into multiple wallets, taking on additional safeguards. Cold storage gets a lot bigger, big part of it. And then, now we're working on how do you secure trillion-dollar wallets. I mean, that's really what we have to be thinking about. And of course, it doesn't mean you put $1 trillion in a single wallet. That's a bad idea. You might have heard about the Bybit hack just a few months ago. Without using any BitGo tech, I can save them $1.4 billion. Don't put more than $100 million in any single wallet. Simple idea. They had that problem.
And use consumer-grade hardware behind it.
They thought they had cold storage, but they didn't, right? So they were using this thing called Safe Wallet, which is basically, just a website that manages the smart contracts. It was on Ethereum. That was not cold, and of course that's what the attackers attacked. So look, it's been a great evolution. One of the things for everybody here, I see a lot of optimism and excitement about Bitcoin. We are getting to the next level. We need to keep fighting. Something you don't often hear about, but I do think it's important. Like, we need to continue to ratchet up the security. We need to continue to think about the various attack vectors that can come against Bitcoin. And they're going to be new. Nation states, could decide to take a negative view on these things. Starting to get multi-jurisdictional custody, where you put keys in all countries around the planet, is actually an important thing. And we can do that. You can't do that with cash, but you can do that with our technology. I don't mean Bitcoin. I mean BitGo. I mean Bitcoin and whatnot. Additionally, quantum computing is coming. I actually don't think it's anytime soon. There's no immediate fear. But you guys probably field questions all the time about, wait, hey, is that thing going to... I hear it all the time. I hear it probably every couple of weeks at this point. So I do think we need to get on it, actually, as a community, as an industry. We need to help push for it. There's a company called Code. You guys heard of these guys? Code. They operate out of New York, run by a fellow named Alex Morkos. He's been a long-time Bitcoin veteran. He helps fund Bitcoin core devs. So they've got a white paper that they've put out for how to address some of the quantum computing issues. The reason I'm worried about it is not because it's actually going to be attacked, but because it's going to be a fear that prevents people from being willing to adopt and make Bitcoin a part of mainstream. So I think we have to address it proactively before it becomes a problem. But it's an exciting time. All right, so anyway, this is a spiel.
That's a look past. What about the future, Mike? What are you most excited about, both personally and for BitGo?
All right, well, I mentioned that BitGo is not a custodian. We are a custodian. We have 7 custodians around the planet. It's a core of what we do. But we are actually remaking the way the monetary system works. And so we started out with just Bitcoin and money, but we're going to hit a lot more than that. There's at least 2 use cases we already talked about. Store value of Bitcoin, of course, stablecoins. I think stablecoins are going to grow bigger than Bitcoin. No offense to Bitcoin. I mean, it's just we all do payments all the time. This is going to be a huge, huge thing. The third thing, though, is really DeFi market structure. Anybody here use DeFi? Great. You ever take a loan on a Saturday? It's fantastic. Like, your socks just go up and down by themselves. It's amazing. It's like magic, right? Without having to fill out any forms, without having to do any AML KYC, you can take loans. These are better broker-dealers. These are better bankers, and I'm talking about smart contracts, than humans. Humans lie, cheat, and steal all the time, which is why we have rug pulls, all these problems. These things are going to start to unlock now. And the fact that we have the regulatory climate where it's at, we have a window that we've never had before. Basically, just getting the basic safe stuff of Bitcoin, stablecoins, that's been a hard pull, right? Now we get to go to the next one because we've actually got a regulatory environment that's favorable. We do need to make sure it gets codified. Actually, I was at the White House Summit shortly after Trump was elected. Honored to be there. But around the table, basically everybody told Trump the same thing. Said, executive orders are wonderful. Thank you. Thank you for changing the stance of the folks that lead the OCC, the SEC, the CFTC, et cetera, but can we please codify this in law? Because if we don't codify it in law, then it's not guaranteed. The next president can change it all back, right? So we have to do that. That's why stablecoin law is so important. That's why market structure is so important. And then back to about BitGo and custody. As you start to rethink market structure, and by the way, market structure is 2 words that mean a lot of things. You guys here probably have a lot of things. What I'm talking about when I say market structure is U.S. capital markets. The U.S. has the best capital markets in the planet. That's due to our laws, it's due to our democracy, it's due to our values, it's due to the fact we've been doing it a long time. The SEC's had a big hand in it and deserves credit, actually, for having made that good. We want to preserve the best capital markets as we go forward, which is why it's so important that we now have regulators that are at least open to this. But, okay, those capital markets, they're not necessarily the most slick systems. Remember the Exchange Act, when was that passed? Anybody know? Somebody knows. 1933. They didn't have many computers back when they designed market structure. We have computers now, so we can do it a little bit differently. But in the market structure that we have, basically what you do is you got the exchange, you got NASDAQ and NYSE on the equity side. If you want to go to the CFTC side, you got CME and ICE. And in both cases, these are basically monopoly companies. That's the center of a capital market. And then around it, you put broker-dealers. Broker-dealers take a risk. Like they'll extend leverage to their clients. Sometimes they blow up, like Lehman Brothers, counterparty credit risk. And then also you create settlement systems. The settlement systems that they created were based on the fact they didn't have computers, right? So every trade had to be settled, right? Somebody's got to send cash to this guy and shares to this guy. And then, so you come up with net settlement and all these complicated things. But what market structure does is it isolates the risk away from the exchange so that the U.S. capital market never goes down, right? Imagine if the New York Stock Exchange went down for an extended period of time. Imagine if we had one crypto exchange that was now doing not just all of crypto, but all the stocks. And of course, Larry Fink has said everything's going digital, right? And imagine that exchange went down and the U.S. capital markets went down. All right, so anyway, I'm excited that we are now solving these problems. It may sound like those are negatives. Actually, it's positive. Like we haven't been able to address these issues before. Back to BitGo as a custodian. Look, I think the custodian is actually a very good center for how you keep secure storage of the asset and how you provide access out to the world in a risk-mitigated way. So where we're actually moving business, like wallets is where we started, we more or less give those away for free. You need wallets, come talk to us about wallets. Chen can give you wallets. It doesn't cost anything. On top of that, we do custody. It still costs a little bit. You know, we got cold storage, we got people, we got vaults that are 1.5 foot thick concrete, we got security guards, we got all this stuff. Plus the
Security guards with guns.
Plus the digital side. You know, there's a lot that goes into that. But even that is not going to be expensive in the long run. Where we actually provide service is we provide trade, borrow, lend, staking services, settlement services, stablecoin services, tri-party collateral management services. We want to move all the revenue kind of up to there is where we make money. But we do it all away from the custodian. So the custodian never carries these risks. And this is back to that capital market structure, right? Like how do you make sure that if you're extending leverage, your custody isn't going to go down and take down everybody, right? So, of course, we've seen this. FTX had this problem. They didn't have isolated custody. And we've seen many exchange failures. One last thing, and then I'll shut up. For the regulators out there, I think there's actually a simple playbook of like what they should focus on. We have had, over the last 10 years, about 30 exchanges blow up. Every one of them is a case study in how to regulate the damn thing. Like we don't need complicated stuff. Like just solve that problem. And a lot of cases, if you just think about, okay, segregated cold storage custody, that's how you do it. All right, anyway.
Some final words for me. In terms of exactly what we do, I think the best way to summarize it is literally everything except mining. You take Bitcoin mining, set that aside. BitGo currently has literally every other piece of the puzzle that you could need for your business. If it doesn't say Coinbase on it, underneath that would be service. It's most likely BitGo. It's most likely BitGo. We provide digital asset infrastructure through and through across all of these different dimensions. We work with large banks. We work with large fintech companies. Work with, obviously, ecosystem. These are L1, L2s that want to get into this space. And, of course, governments. Very, very interesting front. Not really talked about. We work with a lot of governments around the world, of course, with the U.S. government as well. So very excited from my perspective about the future.
A little bit about Chen. Chen
Yeah.
used to be CEO of a company called Lumina that we acquired back in 2018?
2020, actually.
2020.
2019, 2020.
All right. Oh, it seems longer.
It's been a bit.
But he's done product. He's done chief operating officer. He's now taken on the chief revenue officer role. He's got a lot of stories, but knows the space super well. So, all right.
Thank you so much. Thank you, Mike. Thank you, Chen. Lady Rocket, investor, co-founder of Copernic Space, which builds digital infrastructure and is custodial of space. We just financed private moon mission, including the first Bitcoin wallet, which is on the moon.
All right.
So the question is...
That's very cold storage.
Well, pitch me, because we want to select someone who can be built on trust, driven by technology, with our wallet on the moon.
Do we have to move to the moon?
You might have to consider it.
Well, look, I mean, I think when you look at BitGo's technology stack and our regulated custody stack on top, there's a lot of ways to work with us. Some people work with us just on the technology layer, and that's, just use that. And then you can augment whatever you're doing with 2 out of 3 multi-sig stuff. And if it's just Bitcoin, it's multi-sig. If it's other assets, it's MPC, and it's also 2 out of 3. We always preserve that. If you need some of the regulated layers, we've got services there around custody. So anyway, we'd be happy to work with you.
Yeah, let's talk, because it's also a spectacular historical opportunity to grab the message and be the first on the moon.
Great.
Thank you.
Thank you.
Looking forward.
Exciting. By the way, did Blockstream put, didn't they put a private key on a satellite or something?
Potentially, we put private keys on the moon as Copernic Space and as a Lady Rocket, because I financed it. Because I wanted to be a message to all of us.
All right.
Okay, my question is, I heard you say stable coins could be bigger than Bitcoin. So I'm like, all Bitcoin, I think. But how can we support stable coins? Is there public companies? How do you invest in stable coins?
Well, stable coins today, I mean, I guess market cap wise, you've got what, Tether at 140 billion, Circle at 60. Is that about right? There's going to be just a proliferation of all kinds of stable coins over the next probably 6 months. It's gonna go fast. So BitGo, we work with the World Liberty guys on their USD1, so we like that one. But all of these are going to work. And look, I think with stablecoins, you got a couple different types, right? You got algorithmic stablecoins, you got one-to-one backed stablecoins. I only talk about one-to-one backed stablecoins. All that algorithmic stuff, algorithms have always failed. Now, by the way, interestingly, the US dollar also has many stablecoins, right? So we've got US dollar variants all over the world. We've got the Hong Kong dollar, we've got the UAE dollar. The UAE dollar is an algorithmically backed stablecoin. It's partially backed by dollars, partially backed by oil reserves. Hong Kong dollars is one-to-one backed. It's not a one-to-one ratio, but so we do have both types. I guess in some cases, at least the UAE has a lot of oil, so they've managed it reasonably well. I haven't heard of a failure, but maybe I don't understand it well enough. Anyway, these are coming. They're just going to come into apps. You're not even going to see it. You're just going to see dollars, and it's just going to be there. And the reason I think it's bigger is because this is like Venmo and Cash App and PayPal all combined. They're all going to move on to stablecoins. PayPal has a stablecoin as well. It's not as big, maybe 800 million, I think. So PayPal, big company, massive distribution channel. I think 350 million users worldwide or some ridiculous number. I probably have it wrong, but a big number. But they still haven't rolled out stablecoins to all their users. And part of that, I don't know. I don't have any inside information. I'll bet you 100% that it comes down to the regulatory and compliance team on the main business, right? So they've gotten to be a big business. They've grown that. It's healthy. They've got it all stable. It's very conservative. They were afraid that if they cross the streams of the digital with their 350 million users or whatever it is, that they get in trouble. They can't jeopardize this business for this little one. So they didn't. But now we have a regulatory climate where they can start to make that happen. So PayPal could be a good place for it to go. Anything that's one-to-one backed is what I would say is fine.
Cool. Thank you.
Yeah, just how you differentiate yourself from like the future, State Street, Northern Trust, the traditional custodian, DTC. So is it like multi-jurisdictional custody? That's something they're not going to do? I mean, what do you see as your key differentiator there?
Well, let's see. I often draw BitGo as a pyramid. And the reason I draw it as a pyramid is because at the bottom, you have this security technology layer. We have been working on this for 12 years. And you're never done with security. you just keep ratcheting it up. And the attacks of today are going to be trivial compared to the attacks of tomorrow. We've got nation states that are after Bitcoin. Of course, North Korea is well known for being a big attacker. We've been building that for a long time. So I've said this many times that I think Wall Street has never seen the innovator's dilemma. Have you read the innovator's dilemma? Okay, so I'm in Silicon Valley. You go to Silicon Valley, it's like a Bible. Everybody's read it. You go to Wall Street, you're like, innovator's dilemma. They're like, what's that? Never heard of it. And that's because they've had this regulatory capture on the entire financial system for so long, they never had to worry about innovation. Which, by the way, on stablecoins, the reason we have Venmo and Cash App and PayPal is because the banks didn't do their job. If they were innovative, they would have been the ones that came out with the mobile apps. They would have come out with the easy ways to pay. They didn't do it because they didn't have to, because they were fat, dumb, and happy on their regulatory moat. So anyway, I think most of those companies are going to now try to get into digital assets. I think they'll start with Bitcoin. Look, Fidelity came into digital asset space in, 2016? They don't get nearly as much credit as they deserve because they came in early. And as of today, they support like Bitcoin and a little bit of Ethereum. Maybe they support some Solana and something, I don't know, but it's relatively small. The things that we're doing is way beyond that, and getting into DeFi and real-time systems, being able to handle this, at scale all the time, 24 hours a day. We just do a lot more. So we're happy to work with all of those guys. If they want to get jump-started into crypto, call BitGo. Yeah. All right, yes? Oh, it's a book. Innovator's Dilemma is a book by a guy named Clay Christensen. And it deals with this weird question, which is like, why is it that the monopoly always gets toppled by the innovator? So think like IBM toppled by Microsoft. Microsoft, to some degree toppled by Google. Fujitsu hard disks, other things. And it turns out that technology always disrupts. And in the financial services world, technology has been locked out by way of regulation. And all of a sudden, blockchains have figured out a way to invade traditional financial systems. And so it's all just getting overrun right now. Yeah.
Would there be room for integration, or is this a takeover?
The question is there room for an integration or is it a takeover? Look, I don't know. The future's untold. But what I will tell you is that if you just go based on past experience, every single time, the innovator wins and the traditional guy loses. And it's this really hard thing of how do you cut off one limb in order to make another one grow stronger. And you've got like the PayPal example I just used, right? They were on stablecoins, I don't know, 5 years ago?
Yeah.
Long time ago. But they didn't have the courage to go all in on that 5 years ago. Now, if they did, they would be where Tether is. There's no reason Tether would be at their size and PayPal not if they had thrown the PayPal distribution channel at it, but they were afraid to do it. So anyway, it's just hard, and that's why we see over and over again, innovation usually wins. If you read the book, you can even read just the Wikipedia page on. It'll give you a great summary. It's like 2 pages, super easy. Yes.
One last question with regards. It seems like RWAs are coming in within this year. How can we educate the people who are bringing those projects in to safely educate their holders in terms of governance?
Well, RWAs is a big category, and there's a lot of different parties trying to participate. And so far, RWAs haven't had a lot of success. It's a tough problem. So RWAs typically, it's real-world assets. It's the new term, I guess, for tokenization. We've had a couple of different terms for this over the last 5 or 6 years. I think with tokenization of traditional securities, that's probably an area where the traditional financial system mostly wins. I know there's a lot of people excited about it. We've partnered with, I don't know, probably 3 or 4 different companies at this point over the years that have said, hey, I'm from traditional finance, I know how market structure works, I'm going to build my ATS, I'm going to build my broker-dealer, I'm going to put my custodian, my transfer agent all together, I'll build it all. And then they'll come and use my digital RWAs. And the problem is, they think that it's more efficient to use blockchains, but it's actually not. Where's efficiency? Efficiency is you take the cost that it takes to operate something, divide it by the volume. And it turns out that the traditional financial system is incredibly efficient. It doesn't mean it doesn't have unnecessarily high costs. It does. Or it could be a lot cheaper. But the volume is so massive on the US capital markets that Schwab can charge 5 cents a transaction and still make money. So it's very efficient. So there's this misnomer that blockchain-based RWAs are going to be more efficient than traditional ones, and I think that's the biggest impediment. What ends up happening is you build all this stuff, you turn on your market, and you're like, okay, come trade, and then like people are like, well, there's nobody here, so the prices aren't very good, and then like the broker wants 15%, the other broker wants 15%, so the fees are really high. So it's really hard to get that flywheel moving. Now, I don't mean to be so negative as to say traditional finance wins it completely, but I think most people underappreciate that distribution that traditional finance does have. It's unbelievably massive. It's like, you know, for those of us that are Bitcoin fans and like we're afraid of the dollar and they keep printing it, we have more and more, when's it going to go into hyperinflation? The dollar is so big. It's really big. And, you know, nobody really knows, self-included, like how long it's going to take to start hyperinflation. Maybe it's going to happen tomorrow, but I think more likely it's going to take a long, long time, even though the U.S. is not very fiscally responsible. Anyway, I'm not sure I answered your question very well, but okay. Look, it's going to come slowly. People have to find a niche market which is underserved, that's got enough revenue to pay for the U.S. security structure. That's a tough problem. So the niche markets usually don't have enough money, and the existing regulatory structure is very costly. So it's really hard to get going. So that's why I think that it's more likely that traditional finance is able to come in to do some of that, but somebody will find a niche market. This is the great thing about innovation. Like somebody finds something and then it'll go from there.
My quick observation here is it's actually very interesting. These two worlds are coming closer and closer together, TradFi and I guess DeFi. You have, of course, the TradFi guys trying to tokenize stuff. Right? Here's a U.S. security. How do we get it on-chain? And then with all these treasury plays that we're seeing, what are these treasury plays? These are effectively TradFi wrappers on DeFi. And the reason why there's so many of these treasury plays popping up, it echoes what Mike just talked about. There's so much over there in TradFi. The reason why some of the DeFi folks are interested in adding TradFi wrappers on top of crypto, such as Bitcoin, is because they know there's so much depth and liquidity over there. And you have all these things happening. And it's actually very interesting, right? You have a couple of guys here trying to bridge this way, and a couple of guys here trying to bridge back. And over time, I think infrastructure players like ourselves, like guess what? We are that bridge between these two worlds, and it's gonna be great either way.
I think treasury companies are the next ICOs. Anybody participate in ICO? Yeah, all right.
The guy in the back. Other questions?
Okay, so based on security and innovation you were mentioning earlier, how do you maintain your infrastructure? Do you use third-party servers? Do you use Amazon, Google? And speaking of innovation, would it be possible to, because I look at this for self-custody, would it be possible for you guys, for settlement layer, to integrate like a dashboard for marketing affiliates? So that way settlements are marketing is incentivized and built in for every transaction, and you can hand that off.
Okay. Let's see. We talked a lot about more traditional assets, so mostly that was kind of a custodial world. When you're on the institutional side, which is, you know, the people that need the most security usually are the institutions. They have larger amounts of money, but they also have regulatory requirements, and they also have business continuity, right? Like if you run a company and you're holding a bunch of Bitcoin, you don't want your IT guy to be able to run off with the Bitcoin. So those types of people come to us. That's usually custody. Just for the record, I really hope we continue to push the self-custody ecosystem out more and more. It's super important. Like if we end up centralized on a couple of different players, and traditional finance does tend to centralize over time because markets are better when you got the most buyers and sellers, then that we would lose the benefit of Bitcoin, right? The benefit of Bitcoin is that everybody holds it, nobody controls it, et cetera. Second, on our infrastructure, we run all our own infrastructure. So we've been doing this since 2013. We have to run our own nodes. From a security perspective, and I can go into this later, there's real reasons why you have to be running your own nodes. You can't use other people's nodes. So we run everything ourselves. We do that all through a set of secure facilities. There's a lot of depth that goes into it. But we run our own stack. We run our own nodes. We run our own application layer all the way up the top. There's been a few trust companies that have died that used other providers, and they died because they were system integrating things that they didn't necessarily understand. In some cases, they had failures at lower levels. Anyway, we think we just have to own it. That's the only way that we can assure the security for $100+ billion of custody that we have today.
Okay.
All right.
I think we're good.
Hey, thank you, everybody. Thanks for being here.